Most market crashes don't start with panic. They start with silence. No breaking news, no headlines screaming sell, just a quiet warning almost everyone ignores. And history shows us something uncomfortable. Every major market drop was preceded by this exact moment. Let me explain. Before the dot-com crash, before the 2008 financial crisis, before the COVID crash, markets weren't collapsing. They were calm. Too calm. Stocks were rising, confidence was high, and investors believed this time is different. That belief is always the first red flag. Because real danger doesn't look dramatic. It looks boring. It looks stable. It looks like nothing is wrong. But beneath the surface, the warning signs were already there. The warning no one talks about. The quiet warning is not prices falling. It's when fundamentals stop mattering, when companies miss earnings and stocks go up anyway, when debt increases and investors call it smart leverage, when valuations stretch far beyond historical norms and people say growth will fix it. That's the moment experienced investors grow cautious. Warren Buffett once said, "You pay a very high price for a cheery consensus." And right now, consensus is extremely cheerful. Why markets drop after everything feels safe? Market tops don't feel dangerous. They feel comfortable. Everyone is positioned the same way. Everyone owns the same stocks. Everyone believes risk has disappeared. That's when markets become fragile, because when everyone is already in, there's no one left to buy. All it takes is one small shock, a rate change, a liquidity event, a slowdown in earnings, or simply reality catching up to expectations, and suddenly exits feel very small. That's when drops happen fast. The pattern repeats every time. Look back at history. In 2000, tech valuations were justified by future potential. In 2007, housing prices were said to never fall nationally. In 2021, speculation exploded because money was easy and risk felt optional. Each time, the warning wasn't loud. It was ignored because things looked fine. Markets didn't collapse because of fear. They collapsed because of overconfidence. What smart money watches instead? Long-term investors don't watch hype. They watch cash flow, debt levels, valuations versus history, liquidity conditions. When those start disconnecting from price, caution increases. That doesn't mean panic. It means patience. Buffett-style investing isn't about predicting crashes. It's about not overpaying when others stop caring about price. Why this matters right now. When markets ignore risk, risk quietly grows. The biggest losses don't come from sudden bad news. They come from believing bad news no longer matters. That's the quiet warning everyone misses. Not because it's hidden, but because it's uncomfortable to acknowledge when things are going well. Final thought. Markets don't ring a bell at the top. They whisper. And history shows those who listen early don't need to panic later. Stay patient, stay disciplined, and remember, silence has always been louder than headlines. Because the quiet warnings are the ones that matter most.